A high salary is a powerful tool, but it doesn't guarantee a secure retirement. Without a specific strategy, the purchasing power of those earnings is steadily eroded by inflation and the drag of annual taxes. The first obstacle isn't economic, it's psychological. Most of us operate on money scripts, which are subconscious beliefs formed early in life. These scripts often drive us toward unproductive behaviors, like fear-based hoarding or spending money specifically to signal social status. This programming often leads to lifestyle creep. As your income rises, your overhead rises with it, keeping you on a financial treadmill where your net savings rate never actually improves. Because these psychological patterns are so deeply ingrained, willpower alone is often insufficient. To protect your wealth, you need to remove the need for consistent manual discipline and instead rely on a system that functions automatically. Automation is the mechanism that solves the problem of human psychology. It moves capital into the right accounts before you have the opportunity to spend it or talk yourself out of saving it. This structural shift changes your financial default. Instead of trying to save what's left at the end of the month, your investments are funded first. Your checking account only receives what is left over, making conscious spending the final step in the chain. By taking yourself out of the loop, you establish a reliable flow of capital that serves as the foundation for your long-term savings. Automated money needs a destination that protects it. Tax wrappers are government-approved structures designed to shield your investments from being taxed repeatedly as they grow over the decades. Post-tax wrappers, for example, require you to pay income tax on the initial contribution today. In return, you never pay another cent of tax on the growth or harvest. In the US, this is the Roth IRA. The UK's ISA and Canada's TFSA offer similar tax-free protection. Each provides a different path to the same goal, tax-free growth. Pre-tax wrappers work in reverse. You get an immediate tax break now, which lowers your current taxable income, but you agree to pay ordinary income tax when you withdraw the funds in retirement. This category includes the American 401k, the Canadian RRSP, and the British SIPP, the latter of which allows you to take 25% of your total pot entirely tax-free at the start of retirement. Choosing the right mix of these wrappers eliminates the friction of annual taxation, allowing your contributions to compound in full rather than losing a percentage of their growth to the state every single year. A tax shield is only as effective as what you put inside it. To be successful, the asset type must match the specific timeline for when you will need that money. For short-term needs, you maintain a 3 to 6 month emergency fund. This stays in a high-yield liquid account, so it's available at its full face value the moment you face an unexpected expense. But for a 30-year retirement timeline, cash is a liability. As this chart shows, inflation slowly erodes the value of currency. To maintain your purchasing power, your long-term boxes should hold indexed assets, diversified funds that capture the broad growth of the global economy. Matching the right asset to the right timeline ensures you have cash for emergencies today, while your retirement funds continue to grow faster than the cost of living. When you finally reach retirement, the objective is to replace the majority of your working salary without exhausting your savings prematurely. The traditional math for this is the 4% rule. It suggests that if you withdraw 4% of your portfolio in your first year and adjust for inflation thereafter, the remaining balance has a high statistical probability of lasting at least 30 years. The risk is that markets are not consistent. If a major crash happens in your first few years of retirement, a fixed 4% withdrawal cuts deeper into your remaining principal, which can permanently reduce the portfolio's ability to recover. Relying on a rigid withdrawal amount in a fluctuating market can turn a well-funded retirement into a gamble based on the year you happen to stop working. The solution is dynamic spending. Instead of a fixed number, you adjust your withdrawals based on performance, spending less when the market is down and more when the market is thriving. This flexibility protects your principal during economic downturns, ensuring that your portfolio remains large enough to participate in the eventual recovery. This approach connects every pillar of the system, automating your habits, optimizing your tax shields, selecting assets based on time horizons, and withdrawing money intelligently. These steps move your finances away from a source of daily anxiety and toward a self-sustaining system. When the math is aligned with the architecture, your future stops being a question of luck and becomes a matter of engineering.